will be speaking on his career, his life choices, investment, and his book, Dalal's Street, for about 25 minutes. In this session, no one will be able to make any observations or comments. In the second session, after Anurag is done talking, we will open the house for comments and questions, and you will be able to ask your questions or direct your queries at Anurag Tripathi. We have already shared instructions with you, and we hope you are familiar with using this app and the guidelines. But just in case you are not, in the list of participants at the right hand bottom corner, you will be able to see a button that says raise hand. If you want to ask a question, just click on that. We will see that you have raised your hand, and we will forward your question to Anurag Tripathi. Now let me introduce Anurag to all of you. Anurag has led quite a checkered life. After completing his education from the Indian School of Business, Oxford, Anurag joined a bank. After a couple of years in the banking sector, he left his job, went out of his comfort zone, and became a full-time investor. Then again, he changed tracks and tried his hand at writing. In 2017, he wrote his first book, which was titled Kaliyug, and dealt with the art market, the art bazaar. Dalal's Street is his second book and deals, as the name suggests, with the investment market. So we can all look forward to a scintillating conversation with Anurag Tripathi, where he will be talking about his life career, his choices, his investments, and hopefully at the end, we will be able to see some advice coming our way so that we also can laugh all our way to the banks. Over to you, Venus, who is the moderator, and he has all the control over all the audios and videos of all the participants, including mine. Welcome aboard, Anurag. It's all yours.
Thank you. Thank you. Good evening, ladies and gentlemen. Thank you for signing in today to this session of investing during the times of Corona. And thank you for introducing me. I'm thankful to Majha House and Preeti Gill for giving me this opportunity to address you all today. I am the author of a novel called Dalal's Street. It is a thriller on the underbelly of the stock market in India. I used to be the CEO of a retail equity broking outfit in India around 15 years back. And much of what I've written in Dalal's Street is based on that. Some stories that actually happened in real life and some have been fictionalized. But you will get a good flavor about how the stock markets work if you were to go through this novel, specifically for a novice investor, a retail investor. Today, we are going through unprecedented times. No one has seen anything like this before.
Anurag, do you mind if I interrupt you for a second?
Yeah, please.
Your screen is coming sideways. You will have to rotate it because we can't do it at our end.
Okay.
Yeah.
Okay.
That's better. That's better.
Then I'll have to hold it then, okay, in my hand. Yeah.
All right.
Okay.
All right. Yeah.
I'm on my phone.
That's
so.
Fine. Thank you so much. Thank you.
Yeah. So we are going through unprecedented times, and no one has dealt with a situation like this before. However, whenever you invest in equity markets, you tend to draw parallels based on the past. So most of the advice that I'll be giving you will be based on how the markets have behaved in the past, whether it was the 2008 financial crisis or it was 1987 when the markets had crashed, or whether during the time of the Great Depression. The fact of the matter is, the caveat that I want to put is that since these times are unprecedented, the history may not hold true to what we are projecting in terms of the future. So you need to take it with a pinch of salt. Having said that, I'll move on now to describe investing during the times of Corona. I have split this discussion into three parts. The first part deals with who we are. The second part, we're going to analyze the current market situation. And in the third part, we are going to analyze what kind of instrument would be best placed to deal with this current market scenario. So I'm going to start with part one, which is basically who we are. There are three kinds of investors in the market. There are people who have not invested in equities ever in their life, and as such are sitting on either in cash or in debt instruments. So this carnage that we have witnessed during the last month and a half in the equity markets, it has not impacted them. These are people who still have a smile on their face. If you are in this particular group, then I would advise you to relook at your asset allocation and allocate a percentage of money from debt or cash into equities. The second category of investors are people who were caught unaware when the markets fell and have taken this fall on their chin. These are the people who were invested in the markets, and depending upon the kind of stocks or the kind of portfolio they have taken a hit anywhere between 30 to 45% in the last month and a half. So frankly, even I am in this category, and there's no reason to be ashamed if you are one of them, because I've had discussions with a lot of well-known investors as well as money managers, and while they can't say so on television, most of them were caught napping when this fall came. Most of them were almost fully invested or near to fully invested. The evidence also bears out the fact that most people were fully invested in the markets when this fall happened, because if there was a lot of cash waiting on the sidelines, then the market could not have fallen the way it has. So if you are in this segment, then my advice to you would be that you should again look at your asset allocation and reallocate some money from cash and debt into equities. So if I take my own example, I was invested 50% in equities and 50% in cash and debt instruments prior to the fall in the market. As a result of the fall in the market, my portfolio at one point in time was down 40% in equities. So the 50 rupee allocation that I had to equities had become 30 as a result of the fall in the market. So my net worth had declined from 100 to 80, 50 being in cash and debt and 30 in equities. So now what I would do is I would allocate 10 rupees from my cash and debt portfolio onto equities, so as to take my allocation back to 50% in equities and 50% in debt and cash. So post this reallocation, I am back to 40 rupees now in equities and 40 in cash and debt instruments. The third category of investor are people who are not only invested in markets, but they are levered. A person who has taken leverage, he's borrowed money from a market participant. It could be from your broker, it could be from your bank. So he's not only playing on his own money, but he's playing on borrowed capital. If you are in this category, given the high level of volatility that we are seeing in the market, I would advise you to cut back on your investment and go back to a scenario where you have zero leverage. These markets fell the way they did because there was a large quantum of leverage in the market. And the market has found a sense of stability only once these levered positions have been reduced. So going back and recapping, there are three kinds of investors. People who are not invested in equities at all. You need to look at your asset allocation and allocate a portion into equities. Two, people who were invested in equities and are currently sitting on losses depending upon the quality of their portfolio. Again, the advice is the same. You need to reallocate your asset allocation and allocate a portion from cash and debt into equities. And the third component is people who are playing with borrowed capital. The advice here is to remove the leverage in your portfolio and sell your position. Now, going to second part of the discussion, which is evaluating the current market scenario as on date. Frankly, I had this discussion, a similar discussion around 8-10 days back. At that point, our Nifty was at 8,000. It was a much easier discussion because I had advised people to get into the market immediately, at least allocate 30% of whatever allocation or enhanced allocation that they were looking to put into equities. And people have done reasonably well because the market has gone up 1,000 points since then. However, this discussion is a little more difficult today because we rallied 12.5% in the last 1 week. Very frankly, even the global markets have rallied 12, 13%. The Dow has rallied almost 20% from the bottom in the last 2 weeks. So the situation becomes much more difficult. The bigger question today is, given how the pandemic is evolving across the world, what should we do? And every day we're getting new information. We are analyzing this information. Based on this information, the market is reacting in a particular fashion. Now, the market tends to look 3 to 6 months forward. So the price of the market shows you what the market expects is going to happen in the future, 3 months to 6 months down the line. In my opinion, when the market had fallen to 7,500 on the Nifty and the Dow had fallen to 18,500, 19,000, the market had completely discounted scenario one, which is that the pandemic would be contained in the month of April, and from the month of May onwards, it would be life as usual. So the economy will come back to normal over a period of few months. Scenario one talks about a situation where we expect the economy to normalize over the next quarter of the year. Presuming if the scenario holds out, then you still have 3 quarters left to work normally. This is scenario one. Scenario two is a situation where we expect the current lockdown to continue beyond the month of April in the US and rest of the world as a result, and go on probably to May, and in some cases to June, which means basically the entire quarter is a lockdown situation. If it were to come to this, the world economy, as well as the Indian economy, would take at least a few quarters to recover, which means the entire year, 2020-21, will be a washout year. And scenario three is a situation where this pandemic remains with us and it becomes a way of life. There might not be a lockdown, but every economy will work at a level of efficiency which will be lower than the efficiency we see today. And this pandemic might continue beyond the end of this year. Now, there aren't any countries which are talking about scenario three. Very frankly, scenario three is a kind of a doomsday scenario. And being equity investors, we cannot think of a doomsday scenario. We have to be more optimistic. So currently, my discussion today is on scenario one and scenario two. When we were at 8,000 on the Nifty, and the Nifty had fallen, given us a shock at 7,500, I believe that the market had completely discounted scenario one, which means that the scenario one, the turbulence in the economy on account of a closure for 1 month was completely in the price of the Nifty. However, since then, the Nifty has moved up significantly. From the bottom 7,500, we have rallied probably 18 to 20%. We are only, 15, 16% from the high once again. So today, the price in the market, it's a little more risky. Frankly, the decision whether we have bottomed out or not is a function of how the market is going to behave based on the data that we are getting on a weekly basis. And this data is changing. It's changing daily, actually. So depending on how the data moves, I believe that the lockdown is expected to be extended in India beyond the 14th of April. So this information has only come today. So this information has not yet been, analyzed by the market. So you will see a reaction in the market on Monday. But I feel if I draw parallel to what happened in 2008, there were a number of bear rallies in the market before the market found a bottom and started moving up. And I somewhere feel that the current movement that you've seen in the market, which has moved us from 7,500 to 9,000 on the Nifty, is one such bear rally. So I actually expect that the markets have not yet completely discounted scenario 2, which we are slowly moving towards. And as a result, we'll probably discount it when the market opens again next week. And you might see that over a period of a few weeks, the market will again go back to test the earlier lows. I don't know whether they'll touch 7,500, but you could see a movement back to 8,000 levels. Now, the jury is divided right now. There are some analysts who feel that the bottom has already been formed at 7,500, and as such, we should be investing regularly in this market. I am not in that camp. However, having said that, we cannot make a binary decision about investing in the markets, which means, not invest at all or invest everything. And the best way to deal with the current market scenario is to start deploying some portion of your capital that you have decided to reallocate towards equities at every market fall. So if I was an investor today, I would probably go with the assumption that the market has already formed a bottom and allocate 25-30% of my capital and keep the remainder to a scenario where market has not formed a bottom, and wait for the market over the next month and a half to analyze the current evolving situation in the country and give it an opportunity to react to the situation before I deploy further capital. Now we will move to the third part of the discussion, which is from what kind of an instrument is best placed to deal with the current circumstances that face us. I draw parallel from historical data. In 2008, 2009, they found that index funds were able to overperform every actively managed fund in the world post the financial crisis. And one of the reasons, there are two reasons for this. The first reason is that when you have a major destruction in price in the market, like we have witnessed in the last month and a half, a new sector takes the lead next time the bull run starts. It's not the old sector. So in 2007, 2006, you had the real estate sector and you had infra. In 2000, you had technology. And in 2020, this bull run was led by financials, and in particular by non-banking financial companies. Well, I can assure you that when the next bull run comes, it will not be the financial sector which will lead it from the front. So a lot of existing active managers who are heavily invested in financials will have to consequently reallocate their portfolio. The second reason why index funds tend to overperform or give a better performance than actively managed funds during recoveries post a massive market crash is that most actively managed fund managers tend to second guess the formation of the bottom in the market. So when the bottom gets formed, they don't believe in it. So they second guess it. And the reason for that is that they've seen such destruction that they are anchored in seeing a larger fall in the market. Consequently, at the bottom, they do not deploy the entire cash which is available with them. It is only when the market has moved up 8-10% that in retrospect they call out the bottom, which is what is currently happening. If you meet the investor community today, a lot of them are calling out the bottom today at 7,500 when you are already 15-18% above that price. However, at 7,500, nobody was calling out the bottom because nobody knew, very frankly. So as a result of this, what happens is that their actively managed portfolios tend to underperform an index fund, which doesn't have the liberty of taking these calls of whether a bottom has been formed or not. An index fund is a passive fund. It's not an active fund. So whatever money you deploy towards an index fund, the next day, that entire money is used to buy a portfolio which replicates the index without giving the liberty to the fund manager to keep a particular part of your investment in cash or otherwise. So by virtue of this, when the turnaround happens, the only fund which is able to call out the bottom are index funds. Warren Buffett had a bet with all the actively managed fund managers in 2009, and he bet on the index fund overperforming all of them. And I believe he won the bet in 2014 and by a wide margin. So the best product that you need to buy by allocating small sums of money over the next month, 2 months as the story evolves is an index fund. It will overperform any other actively managed fund. It is likely to overperform any other actively managed fund when the market recovers and forms a bottom. This is all that I had to speak about investing during the times of Corona. I am open to taking questions now that you have on this subject. However, kindly limit your questions to macros of the market and don't go into stock specific queries.
Thank you very much, Anurag. I'm pretty sure that was very informative, but since I'm not in this stock investment thing, I belong to that first category of people that you talked about initially. So, but my wife was sitting with me and she is in the commerce branch and she enjoyed your talk thoroughly. So thank you so much. And the house is now open and the first raised hand I see is by Shivani. So Venus, can we have Shivani on screen to ask a question? Yeah, there she is.
Hi. Hi, Anurag. My question is, should we put the money in index funds right now? Okay, saying on Monday morning, we should put select any company and put money in right now or through over a period of time through STP mode?
I would advise you to put money in the STP mode. However, okay, since we don't know whether a bottom has been formed or not, and the fact that we are still a good 15%, 15-18% below the earlier highs, even at this price, it's not a bad price to allocate some portion of your capital into the fund. But it should be through an STP fund. And more importantly, you are also seeing how the situation is evolving every day. We're getting new information, which is based on how this pandemic is impacting us. So if you see a scenario where the lockdown extends, then it will have a negative impact on the economy, which means you can hold on to that STP till a situation arises where you feel that lockdown is slowly, the period of the lockdown is reducing, or you see the numbers coming down, so that it gives more confidence to the administrators to basically call off the lockdown.
But what should be the duration of STP? If I say going for weekly STPs, I should put my money over 4 weeks, 8 weeks. How should I decide upon that?
Well, since we are talking about only scenario 1 and scenario 2, and I am not professing we're going to have a doomsday, so this money should be allocated over the next 8 weeks.
Over 8 weeks, 2 months.
2
Okay.
months, yes.
Okay,
Yeah.
thanks a lot, Anurag. Thank you.
Yeah.
Thank you, Shivani. Thank you for asking that question. And the next question is by Arvinder Chamak. Can we have you online, please, Venus?
Hi, Anurag. How are you? Thank you so very much for enlightening us about everything about the stock market. Now, my humble question would be like the situation in 2008 and 2020 is entirely different. That was something where every economy, when it's every sector of the economy was working. All the industrial segment, all the infrastructure, all the aviation, all the hotel, everything was working. Now, as you suggested to put your money in the index fund, how do you see that it would overperform as compared to as you cited an example of 2008? So to my mind, the situation in 2020 is entirely different.
So the situation in 2020 is entirely different because the first time we've had a complete lockdown vis-a-vis 2008, where the financial sector was constrained. And because the financial sector was constrained, a lot of other industries which were dependent on the financial sector for funding were constrained. However, it doesn't take away from the logic of why an index fund would overperform in such a market, even though there's a complete lockdown. The fact of the matter is that there is a complete lockdown because of the pandemic. And as we see the pandemic improving, the lockdown would also be gradually called off. The market is unfortunately is already looking, 3 to 6 months forward. So it is also closely examining the pandemic, the situation of the pandemic improving, and is taking a call on that basis, which is reflecting in the market. Somewhere there was confidence in the market that this pandemic would get over in the month of April itself. And when I say that, I'm talking about predominantly the large markets of the world. So our mother market is the Dow Jones. And then you're talking about the European markets. Now, frankly, over the next week, there is an expectation based on how things have been evolving that most of these countries in Europe, including America, will plateau out in terms of having seen their worst days. And that is what the market is also predicting right now, which is the reason you've seen these rallies in the Dow and after the Dow, the other markets in the world. India is a little different from this because we haven't really seen a large number in India right now in terms of the pandemic. The numbers are comparatively much smaller as compared to the rest of the world. Now, if these numbers are to be believed, and if we are to open the country by the end of this month, even if they extend the lockdown by another 15 days, that means 30th of April, which is the presumption, then over the next quarter or 2 quarters, the economy will pick up, will come out of this. Now, we have also done a lot of measures in terms of liquidity infusion from the side of the RBI, money being doled out to the farmers and so on to facilitate demand pickup in the economy. So I think as on date, the probability that we are somewhere between a scenario 1 and scenario 2 is what the market is discounting. And based on that, I feel confident from a risk reward perspective that one should definitely start nibbling into the market. Now, if this situation changes, because it's evolving every day, we hear new information. And if you feel somewhere that this pandemic completely explodes as a result of which, the shutdown that right now we're talking 30th of April gets extended to May or June, then the situation will change, which is the reason I am not telling you to allocate the entire sum on day one. It has to be staggered. That's the only way of doing it. But given the current scenario, as I see it today, I feel confident, given the risk-reward ratio, that if you start nibbling into the market, you will be much better off a year or 2 years down the line.
But Pratap, if you allow me, can I ask a very small question?
Chamak sir, we have two more people waiting. If we have time, we'll come back to you again.
Thank you, Anurag. Thank you.
So, can I ask Nahar Sekhri to ask a question? Nahar. Venus, could you put Nahar Sekhri on? Hello.
Okay, let's start the video. Yeah, hi Anurag. That was quite an insight to the discussion. And since you've already said not to ask questions about stock specific, but you also mentioned that after such a fallout, there is always a new sector leader which leads the way. So can you just guide us in your opinion, what you think will be the new sectors leading this time?
So, okay, so well, it's a difficult call. There's a lot of people in the market who have been talking about pharma as a sector, which could lead the next bull run in the country. But I feel that pharma has a very, very small weightage. I think a 3% weightage in the Nifty today. And as such, it will not be able to absorb the kind of flows. So I don't think it will be pharma. Autos could be one sector which could take a lead. It's a large enough sector and it's been beaten down, and the ownership is amongst all-time lows right now. So autos could be one of the sectors going forward, basically discretionary consumption, because it is not on the radar of any analyst as on date. Having said that, the reason for suggesting an index fund is that by virtue of copying the index, it doesn't matter which sector will take the lead. You will be over-invested in that sector. Because as the size of the sector increases, its weightage in the index automatically increases. That's how the index is created. So when I tell you to go and deploy some capital index fund, I am already taking that into account, that you will always be invested in the right sectors. Today, for example, the index has a 59% weightage on financials, and financials led the last bull run. This weightage was not 59% in 2010 when the bull run began, or 2004.
Okay. Yeah, I got it. I got it. Yep.
Right.
Okay,
Automatic.
Instead of now we have, thank you, Anurag, and thank you, Nahar. And the next question is, I think, from Siddharth Kumar Tiwari. Venus, can we have him online? Siddharth Kumar Tiwari, although he has lowered his hand right now. Siddharth, are you with us? Oh, there you are. Hi.
Yeah. Hi.
Yeah.
Actually, I had. Hi, Anurag.
It was hijacked, I guess.
Yeah, I lowered my hand because my question was comparatively similar to what recently was just asked.
Okay.
I was actually asking about the sector and the weightages as well. So I just wanted to understand that. So I got your point. That's why I lowered my hand. But thanks again for the insight that you gave.
Anything else you would like to share or ask?
I think since he's not talking about stocks specifically, so it's more about the sectors currently.
All right. All right. Thanks, Siddharth. Thanks.
Thank you. Thank you so much.
I think we have time just for one more question, and that should be from Preeti. Preeti, can we have you online? Venus? Hello?
Yeah.
Yeah, there you are.
Hi.
Hi, Preeti.
Hi, Anurag. So I'm actually going not into the stocks and shares thing, but basically linking it to your book, which you didn't really tell us anything about. Because I wanted to bring up your last novel, which is basically, I think, out of your own experience as an investment banker. You've used that for that kind of backdrop to create your stories. I just wanted to ask you how much of your own experience, your life, the kind of things you saw when you used to be an investment banker, and you're still continuing with investments anyway. How much of that goes into the making of this novel?
So this novel is part memoir and part fiction. Most of what I saw and heard is what has been written in this novel. The characters have been fictionalized, so there's been a sense of cherry picking the best and the bads. But the story line, parts of it are actually true, and I have seen these things actually happening in the market. So for those of you who are retail investors and who have who are novices to the market, I think it will give you a good color of the market in a language which you will understand and you will enjoy. And the best bit is that the investment community, whether it's Manish Chokhani, all the big names in the investment community have really raved about the novel, because it comes across as from somebody who knows the market quite well. There is much to be learned between the lines of what is said and what has not been said specifically. But when you go through it, you will be able to make sense of how you should deal in the markets. And for retail investors, I mean, it's one book at the cost of me being modest, you should read before you start allocating money to the market. It will give you a good sense of the market, and it will also tell you about the mistakes that most people make in the market.
Actually, it really scared me a lot. So, I mean, even if I had the money to invest, I never would. It seemed like so manipulative. It was scary to see all those guys and what they were up to with your money. So, maybe some other people want to ask questions about investment. Arvindarji wants.
I don't see any of the raised hands, but then we can always go back to Chamak Saab because his question was not complete.
Yeah,
I
maybe.
guess he's raised his.
Thank you.
Hi, Anurag. Welcome once again, and thanking you, giving me an opportunity to ask you. What do you see? How the Chinese market is behaving at the moment? And two, my apprehension as a fresh investor, like Indian economy is based, much of the GDP is based on the MSMEs, and we are, in the past couple of years, I'm not, talking about the political scenario which is happening in India. Don't you think that the market was at the level of 40,000 or 39,000 or 38,000 was hypothetical?
Yes. So the market, I mean, there's a saying in the market that the market is never wrong. So we can, we can argue whether the levels on the market would be justified or not. But the fact of the matter is those levels actually existed, and there were trades which were happening on those levels. So it's not a hypothetical level, so to speak of. Having said that, the last 1.5 years, the market was very narrow. They were, the top 8-10 stocks within the index, both Nifty and Sensex, which were moving up. And the rest of the market was not really participating. So it was a narrow market to that extent. The question that you raised, it's an important question. Yes, the Indian economy is to a very large extent dependent on MSMEs. And given the kind of carnage that you've seen in the market, it will have an impact on liquidity in the market, which obviously in turn will have impact on the capability of these companies in raising money and funds. So one of the, also by virtue of that, there could be a big impact on employment going forward. Because if these companies were not able to do business, then there will be a large scale of layoffs that will happen. We have already seen these numbers in the US, which, they tend to capture data much better than most of the countries. The unemployment number is 16.5 million in the last 2.5 weeks. It's the highest ever. And that basically means that 1 out of every 10 person is unemployed currently. However, these are all the negatives. Now, the question you need to ask is whether the negative is in the price in the market or not. It's easy to be negative right now. At one end, you have all this data, which is negative. On the other end, you have a price. The biggest question, which nobody will tell you, is whether that negative is already priced in. That we only tend to know retrospectively, you know. But I also see positive data, and positive data is a kind of money which is being put into the market. And the kind of money which is being put by the Federal Reserve, kind of money which is being, invested by different government, whether it's the Japanese government or it's the EU or whether India. Now, this money is being pushed in to create liquidity to facilitate companies. We have done, like I can tell you, in Singapore, we are facing the same problem, and we expect unemployment numbers to go up significantly. So the government has taken on itself to say that we're going to pay the salaries of all employees in companies. 75% of the salary for the month of April will be paid by the government. Excuse me. Yeah. So everyone is doing that. The question is whether it's been discounted in the price or not. I think what you're telling me is being discounted in the price, which is the reason the market had corrected in the first place. However, if the number extends further, and if the lockdown extends further, then this number will be very different. Right now, the number is much smaller because presuming a 1 month lockdown and the impact of that lockdown on the economy and the corresponding impact on the MSMEs, the corresponding impact on employment. But if the lockdown is a complete lockdown, say from 1 month to 2 months, the scenario changes completely. That is not discounted by the market right now. So it's an evolving situation. I understand if you're a person who is not an equity investor, seeing the kind of volatility that we have seen, it's difficult during these times to put some capital, allocate some capital towards equities. But having said that, the times in the market, I mean, I always say this, bull markets people talk about, but it is the bear markets which actually make you money, because you don't get these prices. You only get them when there is fear. And if you invest during times of fear and you hold out your investment, when the fear goes away, you will make significant money, because the price will then start talking about a euphoric time when we have already recovered. So because there's uncertainty right now, these are the times when equity should be a part of your portfolio. And if you are one of those people who was not caught in this carnage, then you're much better placed than the ones who have been. I'm advising both to invest. But the fact of the matter is that if you were not impacted by this fall down, then definitely you should reallocate a portion of your portfolio towards equities. You will be better off in the next year or 2 years. Now, the only caveat which I mentioned earlier also is, we are not presuming a doomsday scenario, in which case you will have much bigger problems than financial problems. I mean, if this pandemic was to continue for years and becomes a part of our life, then, I mean, nobody can, project what's going to happen. Then it's a very different case. But given what people are talking about currently, scenario 1 and scenario 2, you will make money over the next 2 years, for sure. And a substantial amount of money if you were to start nibbling into the market today.
Gurpratap, can we have another session with Anurag after a month, so that we share our growth in our investment and
to give your feedback? To give your feedback, right? That invested.
Yes.
But
do evaluate how the market is changing. Yes.
Sure,
Yes.
Anurag.
Yes.
Thank you.
Yes.
Thank you, Chamak sir. Thank you so much for the question. And Anurag, thank you so much for being with us today. It was wonderful having you with us. And I would now call the meeting to an end and request all the members who are participating to please leave the meeting. And I would also request all the members of Majha House committee to stay online for a few minutes. Thank you so much. Thank you, Anurag. Thank you so much.
So I'll log out?
No, you stay put. You stay put.
Okay.
Just for another 5 minutes or so.
Yeah.
I would now request all of the members to stay online for 5 minutes and all the participants to please leave the meeting. Thanks. Hmm. कौन अच्छी आ रही है कौन है दिखाना हम्म I really don't know how many members have left and how many non-members are still here. But still, Anurag, welcome back. And
Thank
let's
you.
talk about your book now. Since
Yeah.
there hasn't been any talk about your book.
Yeah. So Dalal Street is about the stock markets. It's about it's a story of four friends who have passed out of college and they join a equity broking company, and how the environment in this company impacts them. There's cutthroat competition, and how that the internal competition impacts the relationship between the friends. The protagonist Varun has joined a career in equity broking despite his father not wanting him to do so, because his father had lost a lot of money during the Harshad Mehta scam that happened in 1992. So there is a side story which shows the conflict or the generation gap between a father and son. In addition to the to the evolving relationship between four friends, and then there's a story of an industrialist who's trying to hold on to his company, and the only way he can do so is by manipulating the price of his stock. So this industrialist engages a market operator to manipulate his stock. These are the three stories, and the three stories come together in the form of a thriller. And there's a climax, which you will have to read once you buy the book. I will not tell you how it ends. But basically, through the four friends, I take you to the stock markets, through the life of a relationship manager. We have all dealt with relationship managers, whether it's your banker, whether it's your stockbroker, whether it's an insurance agent. And this is basically the life of a relationship manager who sits across the table and gives you an advice. And the story gives you an insight into what he is thinking when he's advising you. My style of writing is dark humor, because I generally write mixed characters. All my characters are gray, so I write people the way they are. And that makes it interesting, because it's difficult for you to judge how the character will behave. His behavior is a function of the circumstances that we put him in. And all the characters in the novel are gray, some grayer than others. And through the eyes of these characters, you see the broad theme being the stock markets, how retail investors are dealt with by the markets, and how they should navigate the markets. That's what the story is about.
The market also
And
plays a character in the book.
I'm
Does the
sorry?
does the market also play a character in the
No,
book?
market not. No. The market is the theme. Is the background theme, since these people are working in a stockbroking outfit. So the market is a theme which keeps coming back to you through the various characters, through his father who's burnt his hands in the stock markets. And so the story basically goes of how Varun evolves as a character through this life, and how he comes back to his family eventually when the book ends.
Thank
The
you.
novel's done. Yeah.
Yeah, I see another raised hand by Preeti. Preeti, we have her online. She is online on screen.
Yeah. Hi again. I mean, I wish we had done some of the book talk even during the regular session when everybody was around. But the other thing that I wanted to ask you about was what's happening in Singapore. Tell us a little bit about the situation there as it's developing, because I remember the last time I met you, whenever that was in December, January, when things were just beginning. This whole Corona thing was something which was just starting off, and we talked about it here in Delhi. Tell me what it's like there now.
In Singapore, we are now in a lockdown. We were not, but last Tuesday we've gone into a lockdown for 4 weeks. The numbers, the daily numbers had come down to into single digits, so things were going very well. But then there are around 200,000 Singaporeans who were studying in the US and in different universities in Europe. And once the universities were shut down and people started closing down the borders, these people had to come back. So we had a spike in numbers, which was predominantly imported, because these 200,000 people came back to the country. And I think probably 2 or 3% of them were infected. And the problem is that these were all the haves. These are the haves who are studying in the Ivy Leagues and the Oxfords of the world. So when they came back, I think the government was not as stringent in the beginning to deal with them. They were put on something called homestay, which meant that they could not go out. But then the homestay was not put on the other family members in the house. So if this was a daughter who had come back, the parents were free to go outside the house, which meant that if the daughter was infected, then the parents carried it out. And it was only when the numbers started increasing that now the ones who are coming back are being quarantined separately from the family into hotels. So they have learned from that. But there has been a spike because of that. And we are in a lockdown till the spike goes back to single digits again. Plus, they have made it mandatory to wear masks every time you're outside the house now. So yeah, I think the mask will become our best friend for the next few months. You'll see a lot of selfies with masks now. That's the new way of life as it's progressing. Um, Economically, I think they are very rich and they can deal with the situation. But the fact is, one thing which is very apparent is that there are going to be some permanent disruptions post this pandemic. And I think to an extent, there will be a change in consumer behavior, especially institutional behavior. So a lot of companies are already cutting down on their commercial lease because they don't think they need the kind of office spaces they used to have earlier. So commercial real estate as a sector will be very badly impacted going forward. irrespective of what happens to the virus. And I think a lot of newer generation, the millennials and Generation Z, who were working in the gig economy, which is basically on people working on short-term contracts and working on freelance, they have suffered miserably in the last month and a half. And it has, brought to fore the disadvantages of the gig economy, which is basically that one, you don't have health insurance, and two, you don't have any comfort on the job front in terms of pension or anything to fall back on. So I want to see how that evolves post the pandemic getting over. So there are some things which will stay with us even after the pandemic goes. I think there will be changes in our behavior post this pandemic.
Anurag, we just have 3 minutes before we sign off, and I see another question by Gurupdev Singh. So please, can we have the last question from Gurupdev Singh? He's going to talk about the not the market, I'm pretty sure.
Yeah.
Yes, you're right. Since you ruled out the third scenario, the doomsday, I would just like to know how confident you are about it, because you've been moving around on the world scene and been hearing all sorts of stories. Do you really think that kind of thing is not going to happen? Because for the next 1 or 2 years, as you say, things, looking a little dismal. What is your take on that?
So yes, sir, I'm very optimistic. So I'm an optimistic person, and I'm an equity investor. So yes, I do not think that we are looking at a doomsday scenario. I feel that we will find some intermittent measures to deal with the current pandemic, which is facing us. People are already talking about people who have been vaccinated with BCG, which is for tuberculosis, that has been seen to have a positive impact on this pandemic. Then people are talking about hydroxychloroquine, and as we speak, there are at least 25 pharma companies which are doing, research on different kind of vaccines. Now, the fact is, the vaccine will take a few years to come, so that will be the time when there will be hopefully a permanent, a solution to deal with this. That you can just get a shot, but I do feel it will not be a pandemic scenario, but I do feel that this could become a part of our life, like a dengue has become a part of our life. It comes every year. We will be better prepared to deal with it. Some people will fall sick, some people will die, but life will go on. I don't think this will completely go, but at the same time, I don't think it will be a complete lockdown either. It's something which has taken us. There's a lot of fear. It has shut down economies, it's shut down countries. But I think if it comes next year, we will not see a similar reaction from countries and people. We'll be much better prepared. So I'm in the camp who does feel that this is here to stay, but not in the current stage that it is in. It will decline in terms of its severity. Also, as human beings, we have a very strong immunity system, and I think a large portion of us will become immune to this over a period of time. So there will be natural selection.
Thank you.
Thank you, Anurag. Thank you, Gurupdev sir. And I believe that's all the questions that we have today. And thank you so much, Anurag, for being on board with us with your talk about your book and the investment thing. It was wonderful having you here. And on behalf of Majha House team, I thank you once again. Thank you.
Thank you. Thank you.
Bye-bye.